Hey guys, welcome back to Ask a CPA, where we unravel complex financial jargon to help you make more informed decisions. Today's topic, the mysterious 83B election. What is it and why you should consider making one? One way to avoid overpaying taxes is to understand the tax code and its various provisions. Now, this can be especially true if you have a complicated tax situation, such as employees or company founders with equity compensation often do. Taking advantage of the 83B election can help you minimize your overall tax outlay when it comes to restricted stock. In today's video, we'll answer the following questions. First, what is the 83B election? How does the holding period work with an 83B election? Now, who should file that 83B election? Who should not file the election? And what happens if a 83B election is not filed? And then we'll go through an example. We'll walk you through an example step by step of an 83B election and show you what the tax savings are. And finally, we'll go over when and how to file the 83B election. Lots of great information to cover in today's video, so let's go ahead and jump into it. So what is the 83B election? Now, the 83B election is a provision in the Internal Revenue Code that gives an employee or startup founder the option to pay taxes on the total fair market value of restricted stock at the time of granting. Now, if you expect your restricted stock to appreciate significantly between the grant date and the vesting date, you may wish to accelerate the tax on these shares and have as much appreciation as possible treated as long-term capital gains versus ordinary income. Now, the 83B election essentially transitions income that would normally be taxed as ordinary income, with the highest tax rate being 37%, to be taxed as long-term capital gains, which is a more favorable 20% tax rate. The 83B election documents must be sent to the IRS within 30 days after the issuing of the restricted shares. In addition to notifying the IRS of the election, the recipient of the equity must also submit a copy of the completed election form to their employer. The 83B election starts the capital gain holding period for all shares covered by the election. Now, this is important because if you hold the shares for more than 1 year, then the gain will likely qualify for a lower long-term capital gain tax rate. Now, if you hold the shares for more than 5 years, then the gain may be excluded from your taxable income under the qualified small business stock rules under Section 1202 of the tax code. 83B elections are ideal for startup founders or executives of public or privately held companies. Basically, if you receive restricted stock awards or options as part of your compensation package, there may be substantial tax benefits of making this 83B election. Now, there are 4 main reasons why you should not file an 83B election when granted shares of stock. First, your stock must be subject to a vesting schedule. Now, 83B elections are applicable only for stock that is subject to vesting. If you receive a grant or fully vested stock, then you should not make an 83B election. Second, if you receive restricted stock units, RSUs, you do not qualify for the 83B election. Since no stock is issued at the time of the RSU grant, the 83B election does not apply. Third, if you don't plan on staying with the company to vest your shares fully, then the 83B election may not be the right choice. Since you are prepaying the tax on these shares, if you don't plan on vesting your shares, then you may be better off foregoing the 83B election. Finally, if you think the value of these shares will decrease in value, then the 83B election doesn't make sense. In effect, an 83B election means that you prepay your tax liability on a lower valuation, assuming the equity value will increase in the value in the following years. However, if the value of the company instead declines in value, then this tax strategy would ultimately mean that you are overpaid in the taxes by prepaying on the higher equity valuation. So without an 83B election, you aren't taxed at the time the stock is issued to you. However, every time your stock vests in the future, you have to pay ordinary income taxes to the extent that your stock's value has increased from the date you purchased your stock. Now, when you sell your stock, you will owe capital gains tax on the difference between the value of the stock at sale and the value of the stock when you were taxed at vesting. Capital gains tax rates on property held for more than 1 year are generally lower than ordinary income tax rates. The length of time you hold your stock is called the holding period, and if you don't make a Section 83B election, your holding period will begin when the stock vests. Okay, so let's take a look at this example. So in this example, the founder was granted 400,000 shares subject to a vesting schedule at 0.01 cent value, which equals $40 in initial value. 400,000 shares times 0.0001. The shares are subject to a 4-year vesting schedule where the founder will receive 100,000 shares each year he continues or he stays with the company. For this example, we're going to be assuming that the founder sells all of his shares once they're fully vested in year 4. We're also going to assume the shares appreciated in value over the 4 years to 50 cents in year 1, $1.50 in year 2, $2.25 in year 3, and $4 in year 4. Now let's look at the math with the 83B election. So the founder files the 83B election and recognizes the $40 of ordinary income in year 1. Now when he sells the shares in year 4, he'll receive $1.6 million, less his cost basis, the initial $40 which he paid in year 1. And then he'll have a capital gain of $1,599,960. So if we assume 37% ordinary income tax rate and a 20% capital gains tax rate, he would owe $320,007. Now let's take a look at the same fact pattern but without the 83B election. So in year 1, the founder will receive 100,000 shares of stock at a 50-cent par value and will receive $50,000 of ordinary income. Since 100,000 shares will vest each year, he will only be taxed on the shares that vested. So in year 2, he'll receive another 100,000 shares, but this time the stock is increased in value to $1.50 per share. So he'll have to recognize $150,000 of ordinary income in year 2. In year 3, the stocks continue to increase, and it's now $2.25 a share, so he'll recognize $225,000 of ordinary income in year 3. In year 4, now the stock has jumped way up to $4 a share, and he'll recognize $400,000 of ordinary income. So over the 4 years, without an 83B election, the founder will recognize $825,000 of ordinary income. Now if we assume a 37% tax bracket, that's $305,250 of income tax. Now when he sells the shares in year 4, he'll recognize an additional $775,000 of capital gains, which is the $1.6 million sales price less the $825,000 of basis. So using a 20% tax bracket, he would pay an additional $155,000 of income tax on this sale. So the total tax paid in this example without filing an 83B election would be $460,250. So the 83B election would have saved the founder $140,243. Now, of course, there are many variables to consider, but as you can see, the tax savings can be quite significant. So now let's go over when and how to file an 83B election. Now, it is critical to remember to file your 83B election within 30 days of being issued or granted those restricted shares, or within 30 days of exercising your options early. Not doing so results in your company shares being taxed upon vesting as ordinary income. But keep in mind that filing an 83B election is usually irreversible, so carefully consider whether or not you want to do so. Though there are benefits and drawbacks to consider when deciding whether an 83B election is best for you, the process itself is fairly straightforward. the employee completes and signs the IRS Section 83B form or letter that details certain key information. Now, first, you want to make sure you include your personal identification information, which would be your name, your address, and your social security number. Next, you want to include a description of the property awarded. Now, this could include the number and type of shares and of which company, along with the date received or purchased, and any restrictions on your shares in which they are subject to, and the fair market value of these shares on the date in which you received or purchased them. Next, you want to include the amount paid for the company shares. And finally, you want to include the amount in which you will indicate as gross income on your personal individual income tax return. Now, you just want to make sure that you mail a copy of the election to the IRS Service Center and provide a copy to your employer. Of course, it's always best practice to send your election form through certified mail with a return receipt in case you ever need to prove that it was sent by a particular date in the future. Now, if you're not sure whether an 83B election fits your needs, reach out to your CPA who can help you decide whether it makes sense to move forward with an 83B election. And that's all for today's video for Ask a CPA. If you have any more burning financial questions, make sure to drop them in the comments down below or leave us a note on our website. Again, that's askacpa.co. Don't forget to like and subscribe and hit that bell notification to stay updated on any new videos. And that's all for today, guys. We'll see you in the next video. Take care.